Alright, we're going to talk about buying and selling stock. This is part two. Earlier we talked about the players or the individuals involved in stock market investing. We talked about the brokers. We talked about the buyers and sellers of stock who make up the stock market. And now what we're going to do is we're going to get into the actual technical aspects of buying and selling stocks. Alright, so let's talk about odd lots versus round lots. And this is something like these terms here, odd lots and round lots, are not going to be used frequently. However, it's something that I felt like you guys needed to know. Just in case some financial advisor or some stockbroker that you guys come in contact start throwing around these terms, you won't be lost. You'll actually know what the hell they're talking about. So with that said, let's go ahead and go into odd lots versus round lots. Alright, so round lots. A round lot is simply 100 shares of stock or multiples of 100 shares of stock. And so an example of a round lot would be a purchase of 300 shares of stock, which consists of 3 blocks of 100 shares. Okay? So you bought basically 3 round lots of 100 shares. An odd lot consists of less than 100 shares of stock, and pretty much, unless you're a wealthy individual, you're just the average Joe, just like I'm the average Joe. A lot of the stock purchases that you make will consist of odd lots. They will be less than 100 shares. So an example of an odd lot would be a purchase of 25 shares, which is clearly less than 100 shares. Mixed lots. Mixed lots is a transaction that consists both of round and odd lots. And an example of a mixed lot would be a purchase of 125 shares of stock. It includes a round lot, which is 100 shares. It has a block of 100 shares, and then it has an additional 25 shares, which is an odd lot. And hence, since it's a mixture of a round lot and an odd lot, it's called a mixed lot. And now we're going to talk about real-time orders versus regular orders. And keep in mind that when I talk about orders, that's synonymous with trading. So when I say real-time orders, I'm talking about real-time trading. When I say regular orders, I'm talking about regular trading. That's just something to keep in mind. So a regular order is an order to buy or sell stock at the price available at the time the order is filled. And this is something that occurs, like I have an account, a brokerage account with ShareBuilder, and ShareBuilder, when I make orders for stock, unless I specify that I want it to be done in real time, they will place that order basically when they get to it. So say for instance, if I wanted to purchase some stock in McDonald's, if I'm placing a regular order and I place that order on, let's say, Monday, if it's a regular order, that order may not be actually filled until Wednesday, and so the price was different. Okay. So an example of a regular order: you put in an order for 2 shares of Starbucks. The order isn't expedited immediately by your broker. As a result, the market price for the stock may be higher or lower when the order is finally filled by your broker. It's the same example. I put in a worst case scenario. With my example with the McDonald's stock, I said that the shares were higher. Well, it's a possibility that the market price for the stock may be actually lower a couple of days later. So it can work both ways. Usually if you are involved with an automatic investment plan or a direct investment plan, then you will encounter regular orders. And this is not really something to just go crazy about. It's just something that you need to know. I'm just giving you and letting you know what options are available to you when trading. So real-time orders. Real-time orders is an order to buy or sell stock immediately at the price available. And these orders are really, they're filled within minutes, if not seconds, from when the order was placed. So the market price for the stock at the time that it's bought or sold it doesn't really change much, if at all, once the order is placed. And this is primarily the method that is used by day traders or stock traders who monitor stock prices throughout the day. And there are differences in commissions. Usually the commissions that you would have to pay for buying and selling stock using real-time methods is a little bit higher than placing regular trades, because the brokerages consider these as they're specialized, or that they are luxuries. So usually you will pay a special commission for making real-time trades versus regular trades. So there are a couple of types of real-time orders. If you want to control the amount that you spend or limit the amount that you lose on a stock, there are a couple of options out there. And of course, these special benefits come with a price in the form of higher commission fees. So the first type of real-time order that we're going to talk about is a limit order. And a limit order is an order to buy at or below a specified price, or to sell at or above a specified price. And this is the way that you will control what you will pay for a stock and what you will sell for a stock, what you will sell a stock for. And what investors do is they use this strategy to limit their losses or prevent overpaying for a stock. And this is important. I don't want you guys to feel like you're overwhelmed at this point. I know that it may seem confusing, but these are the different options that you have. When you open your brokerage account, you will have options like this. So I just want to explain this and make sure that you understand the options that you have. So let's look at an example of a limit buy order. Okay, so let's say you place a limit buy order to buy 75 shares of Microsoft at $20, and right now the stock is currently trading at $21 per share. So basically, once that price falls to $20 or below per share, your broker will at that point execute that order. He will make that order happen. Once the price exceeds $20 per share, the broker will stop the order. So, and as you see below, you see that the $21, once it gets below that point, or once it gets to 20, it says, okay, we can start buying. Once it gets above 20, we're saying, hey, we need. Alright, so let's look at an example of a limit order, and in this case you're selling some shares. So you place a limit order to sell 20 shares of Starbucks at $22. Okay, so right now the stock is currently trading at $21.50 per share. Okay, and once the price rises to $22 or above, your broker at that point in time will expedite the order, meaning that, hey, we can sell now at $22 per share, because it's because your the limit that you put the limit order that you put in was to sell Starbucks shares once they reach $22. So at $22 you can sell. Now once it gets below $22, then you want to stop selling. Okay, and keep in mind that these market prices may never be reached, and so you may never buy or sell stock at the particular price that you want. And this is what we mean about, this is what I'm talking about as far as the stock market. It's based on the willingness of sellers to sell and at what price, and the buyer's willingness to buy and at what price. So sometimes you may not reach an agreement, and you may not sell your stock. You may have to hold on your stock and sell it at another day. These orders will not be activated until they reach specified price points. So if they do not reach the limit that you set, the stock will not be sold or bought. And there are different forms of limit orders. There's a fill or kill order, which simply means that if the limit order cannot be filled immediately, it is canceled. And so what that means is, say for instance, on Monday you say that you want to sell 20 shares, but you only want to sell them at $25. If it doesn't happen on Monday, then that order is canceled. Okay. A day order means that if the limit order is not executed by the end of the day, it is canceled, which is pretty much the same thing as the fill or kill order. A good till cancel order means that the limit order is in effect unless executed, canceled, or renewed. So basically, if I wanted to sell my shares on Monday and it didn't happen on Monday, it will go, if it has to go all the way to the end of the month, it can go all the way to the end of the month because it's good till it's canceled. Alright, so stop loss orders. A stop loss order is an order to sell a stock when the market price reaches or drops below a specified level, and this minimizes your loss on your investment in stock. All of these orders happen in real time once activated or your specific market price is reached. So keep in mind that a stop loss order is something that investors use to minimize loss. If a stock is dropping, there's only a certain amount of money that they're willing to lose. So let's say you have stock in ExxonMobil and the stock is currently trading at $95 per share. You place a stop loss order with your broker to sell if the price drops below $90 per share. So basically, once it hits $89 per share, your order will be activated and you will sell at the best price available to avoid a big loss, hence stop loss. Okay, so basically you have some shares and you probably really don't want to sell your shares. You probably want to hold on to them because they've been doing well, but maybe the market is not doing too well at the time, or maybe the company is involved in a nasty lawsuit which has affected the share price, and so you say, wait a minute, I'm going to try to get out of this stock. If it drops below this price, I'm just going to sell it and cut my losses. And so you would put in a stop loss order. So in summary, stock is bought and sold in round lots, odd lots, or mixed lots, and you can place orders to buy and sell in real time or regular orders. And regular orders are usually associated with automatic investment plans or a direct investment plan. And if you want to control what you spend or lose on a stock, you can place special real-time orders called limit orders or stop loss orders.